Okay, I'm going to just show you a technique. I'll call it the Lynch method. It's just basically a way of analyzing your income statement and your balance sheet to get your cash collected from customers. It's another way of doing this. Now, I'm using debits and credits here in accounts. I'm not actually making entries. It's just a way of organizing it so I can ultimately figure out how much cash was collected and how much cash was paid for each of these items. So I'm going to first start with revenues, because cash collected from customers comes from the sale of goods. Revenues is a normal credit balance. So I'm going to go here and go get that amount, 18,000, right off your income statement. And what I do I just assume the other side is to cash. It's not in it, but it would be if there were no change in any current asset or current liability related to this, or if there were no receivables. In other words, we collected all our revenues. But this isn't the right answer. I'm going to be adjusting it. I have to first adjust it for doubtful accounts expense. And that's because when we go to our balance sheet, you're going to see that it's accounts receivable net of allowance. So I have to take into effect the decrease to my sales related to bad sales. So I went in and put equal minus this because I don't want signage in this analysis. This basically is saying debit doubtful accounts. And I'm just, again, these aren't entries. I'm just going to credit cash as the other side. So basically you're going to show the impact of that account, the normal, way it would be recorded if it were recorded the first time, but instead of the typical other side of the entry, I'm using cash. Now I'm going to go to the balance sheet and I'm going to look at the change. And if you look at this, it went down, right? Just looking at that right there, to get accounts receivable net to go down takes a credit. So I'm going to skip a line here. Well, I'm going to make the other side be cash. But down here, I'm going to credit accounts receivable net. And I'm going to put that 980 here. Now you can type it or link it. This is, again, just a technique. And the other side I'm going to assume is to cash. Now, as far as this goes, I can now determine cash collected from customers by taking these cash amounts, debits being adds, credits being subtracts, and get your cash collected from customers. So let me prove it out. Cash collected is equal to positive, debit, credit to cash, negative, and a debit. And voila. All right, let me show you inventory. Clear this? All right, inventory. Cost of goods sold on the income statement. Cost of goods sold would be a debit. So let me go get my cost of goods sold. And again, I have to go negative because you were required to record all expenses on your income statement as negative amounts. And again, I'm just trying to get the amount and its absolute value. So I'm just, the technique is just assume the other side is to cash, even though it wouldn't be. Now what I have to do is look at the related balance sheet accounts. Well, inventory is one of them. And inventory, in this example, it went up. To get inventory to go up, I would debit inventory. So I'm going to take that change, that 1690, and then I'm going to pretend that the other side is to cash. Pretend it's a technique again. These aren't real entries. It's just a way of organizing your information to get cash paid. Now, remember that with cost of goods sold, the amount of cash paid for the goods is not just what you sold, but also what you maybe bought. So in other words, I have to look at the change in accounts payable along with the change in inventory. So again, with the direct method, you look at the related current asset and current liability accounts. There's two with supplies and with inventory. So I'm now going to go to accounts payable, my current liability, and I see here it went down by 2,300. How do you get accounts payable to decrease by 2,300? Well, the normal balance of payables is credit, so a decrease to it would be a debit. So I'm going to make that debit. Sorry, how much was it? 2,300. And I'm getting rid of signage. And I just assume the other side is to cash. And now I can, like I did before, get my cash paid for inventory or merchandise. All right, let's go through it. This is a minus, so it's a credit minus, right? And then another minus, and then another minus. So these basically both are uses. So the cash paid for my merchandise, my inventory was 13,500. You can keep going. Let's just do one. Let's do cash paid for operating expenses. So expenses, again, I would go to my income statement because I'm going to prove this amount and get my operating expenses. And that would be a debit. So other operating expenses, let's go get that off the income statement. Again, I'm going to, oops, sorry, I have to make it equal minus. Get my, my other operating expenses, 600. And then just assume the other side is to cash. In other words, if there were no accrual accounting or any changes in liabilities, current liabilities related to these other operating expenses or any prepaids related to this, it would be that amount. But now I'm going to go to my balance sheet and I'm looking for anything related to other operating expenses. As far as the income statement goes, this is not related to others. This is my insurance, but what I do have down here is accrued liabilities. And it went up. To get a liability to go up, that would be a credit. How do I know that relates to other operating expenses? Well, if you recall back to your journal entries when you're recording, adjusting entries at the end, you record all expenses in the period incurred. It's the accrual accounting, and the liability collectively is called accrued liabilities. It includes things like utilities payable and payroll payable, wages, salaries. So anyways, this went up. So to get a liability to go up, that would be a credit. That amount of that change was 100. Now I'm going to go though and assume the other side was to cash. So I can just see the impact on cash. So now I've got it, cash paid for other operating expenses. I'm not going to put that title in there, is equal to, all right, now cash paid, so it's negative and it's a credit. So I'm going to go, oops, minus 600. But now you'll notice that we're debiting, so I'm going to add that. And the cash paid is just 500. In other words, we didn't pay all of our other operating expenses. We gave some IOUs instead of cash. That was a source of cash. Cash paid for interest. Look again on your balance sheet for interest payable. There is none, so we must have paid it all. So that one's simply the amount on our income statement. So that was just a technique. Again, these aren't real entries. It's just a way of organizing your thoughts, because sometimes it gets confusing and it's like double negatives. And, you know, in other words, on this, if you look at this formula again, you had to take your revenues and then we're adding a negative amount to subtract it. And then here again, with this, it was a source. And because of the way the math works here, we have to do, again, a double negative to get there. That can be difficult. So I like just to check by doing the technique I just did. I hope that's helpful. If it's not, you figure what works best for you in terms of thinking through whether something is a source or use, whether it increases or decreases, and when you look at the expense versus the balance sheet to get to your cash collected or cash paid. Good luck.